Most people hear the phrase, short the market, and imagine something glamorous. They imagine a man alone in a room, seeing what the crowd cannot see, betting against the madness, and walking away rich, while everybody else stares in disbelief. It sounds cinematic because, once in a while, it is. That is why the story is so dangerous. A lot of people do not want to understand what shorting really is. They want to feel what the movie felt like. They want the thrill of being early, the pride of being right, the fantasy of making money while everything burns. I understand the attraction. I also distrust it. Because the market has a very cruel habit. It makes the most dangerous things feel intelligent right before they become expensive. That is exactly what shorting can do. The source material you uploaded opens with The Big Short and Michael Burry's famous bet against the housing market, then asks the question ordinary people always ask after hearing a story like that. What does it actually mean to short? And can regular investors do it too? File site turn 43, file 0 Fay, that is the right question. And once you answer it honestly, a deeper truth appears. Shorting is not magic, it is not a hack, it is not a secret backdoor into wealth. It is a very specific financial arrangement with very specific mechanics, very specific risks, and very specific emotional demands. If you do not understand those things coldly, then what looks like a sophisticated bet can become one of the fastest ways to hand your money to your broker, your counterparty. And the market itself, that is why I want to talk about shorting in a different way. Not as a trick, as a structure, not as a movie scene, as a balance sheet problem, not as a path to feeling clever, as a test of whether you truly understand asymmetry, leverage, and survival, because that is what shorting really is. And once you see it clearly, you may discover that the lesson ordinary investors should learn from the famous short sellers is not go do what they did. The deeper lesson is often much more boring and much more useful. It is this: understand how negative bets work, respect how dangerous they are, and realize that for most people, the best way to profit from a collapse is not to become a heroic short seller. It is to survive the panic, keep your capital, and be ready to buy when the four sellers finally finish their work. That is a very Buffett way to look at it. Not because I am against learning mechanics, quite the opposite. If you do not know how shorting works, you are missing something essential about markets. But mechanics are not instructions. Sometimes understanding how a machine works is mainly useful because it teaches you when not to climb inside it. That is where I want to start. The ordinary investor begins with a very simple idea: buy low, sell high. Find something worth more than the market currently thinks it is worth. Buy it, wait, and hope that time and reality close the gap. That is normal investing in its plainest form. The file says this directly when it introduces traditional value investing. You buy a stock because you think it is undervalued, and you profit when the price rises closer to what you believe its true value should be. File site turn 43, file 0 fine. That is a clean starting point. Shorting flips the logic over. You do not buy something because you think it is too cheap. You borrow it because you think it is too expensive, then you sell the borrowed thing now, hoping you can buy it back later at a lower price, return what you borrowed, and keep the difference. That is the whole idea. The file explains it with a playful example using a fictional cheeseburger company. But the structure is correct. You borrowed 10 shares at $50. Sell them immediately for $500. Then if the price later falls to $30, you buy the shares back for $300, return them, and keep the $200 difference. File site turn 43, file 0 Fay. That sounds elegant when the price falls. That elegance is what seduces people. It feels like intellectual control. You identified a lie, you positioned against it. Reality came around to your view. You got paid for being early. Wonderful. Now let us talk about the part the public usually hears too quickly and respects too little. If you are long a stock, the most you can lose is what you put in. If you buy $100 worth of stock and the company goes to zero, you lose $100. That is painful. It is also bounded when you are short. The other side of the equation is not bounded in the same way. The file puts this cleanly. A stock can only fall to zero, but it can rise forever, which means the losses on a short position are theoretically unlimited. File site turn 43, file 0 Fay. That sentence should rearrange your emotional relationship to shorting immediately. Unlimited losses. Those are not decorative words. Those words mean you are entering an arrangement where being wrong is not just unfortunate. Being wrong can become mathematically violent. If the cheeseburger stock rises from 50 to 70, your position is not merely not working yet. You are down money. If it rises to 101, 50, 200, the problem gets worse. And unlike the long investor who can say, the stock can only go to zero, the short seller cannot reassure himself with a floor. There is no floor on the upside. That is what makes shorting psychologically different from ordinary investing. When you buy a cheap business, time is often your friend if your analysis is right and the balance sheet is sound. When you short an expensive stock, time can become your enemy in several ways at once. The stock can rise, borrowing costs can rise, your broker can demand more collateral, your emotions can crack, the crowd can become more irrational than you thought possible. That is what many intelligent people underestimate. They think being right about valuation is enough. It is not enough in a short. You must be right, liquid, patient, and sturdy enough to survive the period when the market becomes even more wrong than you thought it could. That is a much harsher test. Michael Burry's 2008 housing short became legendary not simply because he was right. He was right, and he survived the stretch when being right did not yet pay. That is a different level of difficulty. That is why I have always said that in markets, timing and structure can matter as much as insight. Insight alone is not a complete defense. The source file mentions margin accounts as a required feature of shorting, and that matters a great deal. File cite Turn 43 file 0 Fe. A margin account is not some small paperwork detail. It is the legal architecture that lets the broker protect itself while you take the directional risk. The broker wants collateral. The broker wants the right to demand more capital if the trade goes against you. The broker wants the right to close you out if the risk becomes too large. That is the broker's perspective. It is rational. It is also merciless. This is why the phrase margin call matters so much. People hear it and think of it as a technical inconvenience. A margin call is the market translating your wrongness into an immediate funding demand. If the position moves sharply against you, the broker does not ask whether your thesis is intellectually interesting. It asks whether you can post more money. Now, if you cannot, the position can be forcibly closed. That is what makes shorting so different from the heroic fantasy version many people carry in their heads. The fantasy says, I am right, so eventually I will win. The structure says, even if you are right in the end, can you survive the path? That is the question. And for many ordinary investors, the honest answer is no. This is one of the reasons I distrust romantic talk about famous shorts. The story always gets cleaned up in retrospect. The big winner looks inevitable, the risk looks manageable, the conviction looks noble. What often disappears is the ugly middle. The cost of being early, the pressure from counterparties, the market pain, the internal doubt, the social isolation, the possibility of ruin even though the thesis later proves correct. That is what shorting really contains. The file also explains how brokers are able to lend out stock in the first place. And this is an important piece of plumbing ordinary people. Usually never think about shares and margin accounts can often be lent out. Some brokers also run voluntary stock, lending programs where owners allow their shares to be borrowed in exchange for a fee. File cite Turn 43 file 0 Fe. That seems like a side issue. It is not. It tells you something crucial about modern markets. Ownership is not always as simple as people think. The same share can sit in your account, look like yours, and still be part of another person's negative bet if the custody structure allows it. That is a fascinating detail because it shows you again that the market is not just about opinions on price. It is a system of permissions, collateral, custody, and legal relationships. Shorting exists because the system lets people borrow other people's ownership temporarily. That is structurally very different from simply buying and holding, and because it is structurally different, it produces very different risks. Now, before I go any further, I want to say something that many people need to hear in a Buffett voice. Most investors do not need to become good short sellers. That is not false humility. That is judgment. I have spent my career preferring the side of the table where the downside is bounded, the upside can compound, and time often helps rather than hurts. Shorting reverses much of that comfort. It often gives you bounded upside and ugly downside. The most you can make on a short is if the company goes to zero. The most you can lose is, in theory, unbounded. Why would I want to make a long habit of living inside that kind of payoff structure? You must have a very special reason, a very special skill, or a very special edge. And most ordinary investors do not have one. That is not an insult. It is just arithmetic. Now, this does not mean the study of shorting is useless. Quite the opposite. If you understand shorting, you understand something deeper about markets. You understand that prices do not only rise because people are optimistic, they also fall because people are willing to make aggressive negative bets. You understand that some assets can be squeezed upward because too many people were short and had to buy back under pressure. You understand that liquidity can disappear exactly when a short seller most needs it. You understand that a crowded short can be as dangerous as a crowded long. This kind of understanding makes you a better investor even if you never open a short position, because markets are not polite auctions of value. They are crowded fields of positioning. Now let us talk about inverse ETFs, because the file correctly presents them as a simpler route many ordinary investors can actually access. An inverse ETF is designed to rise when the underlying market or index falls, giving you a way to profit from declines without borrowing shares directly yourself. File cite Turn 43 file 0 Fe. This sounds safer because, in many ways, it is structurally safer than direct shorting. You buy a vehicle, your loss is bounded by what you paid for the vehicle. You do not face classic unlimited loss mechanics in the same direct way that matters. But the file also includes the crucial warning. Inverse ETFs are generally built for short-term trading, not long-term holding because they reset daily. Over time, that daily reset can create performance decay, especially in volatile sideways markets. Fay turn 43 file 0 Fay. That point is not technical trivia. It is central. A lot of people think they have found a simple cheat code. Why not just buy the inverse ETF and sit there while the market collapses? Because the instrument itself has a design, and that design is not built for your fantasy. Daily reset means the path matters, not just the destination. If the market falls in a straight line, fine. If it bounces violently, chops, whipsaws, and makes progress in a messy way, the inverse product can behave much worse over time than novice investors expect. This is what happens when people use a tactical weapon as though it were a long-term investment. Again, mechanics matter, structure matters. The market punishes laziness about structure. That is one of its favorite punishments. Now, let me step back and tell you what I think the most useful part of the whole file is. It is not the short selling tutorial by itself. It is the final move. After discussing direct shorts and inverse ETFs, the source pivots to a much older and cleaner strategy. Sell. When you believe markets are wildly overvalued, preserve your capital. Then buy back after the crash when stocks are cheap again. Fay turn 43 file 0 Fay. That, in my view, is where the deepest lesson lives. Because most ordinary investors do not need a career in direct negative bets. What they need is a more intelligent relationship to overvaluation, panic, and opportunity. The public often imagines there are only two choices: either stay long forever no matter what, or become some dramatic short seller betting against civilization. That is foolishly binary. There is another posture. You can become more cautious when valuations become absurd. You can hold more liquidity. You can reduce fragility. You can raise cash. You can stop pretending every cycle deserves maximum exposure. You can wait. And waiting with money is very different from waiting with empty pockets. That is the cleaner, older, more Buffett-like version of profiting from a decline. Not necessarily by borrowing what you do not own and selling it, but by refusing to overpay, keeping your purchase power, and then buying what others must sell after the break. This is not as exciting as the movie version. Good excitement is often expensive. A great deal of the public's fascination with shorting comes from ego, not necessity. People like the idea of seeing through the lie. They like the idea of calling the top. They like the idea of standing apart from the crowd. I understand all of that. But in my experience, the better question is not, how do I feel smartest in the collapse? The better question is, which structure gives me the best chance of surviving and then taking advantage of the collapse? That is a more serious question. And for most people, the answer is not become a leveraged negative bettor. The answer is something closer to this. Do not overpay when the market is insane. Hold more liquidity than the crowd thinks is cool. Learn how panic works. Understand that crashes recur. And when the selling becomes forced rather than rational, be the one who can buy. That is a strategy ordinary people can actually use. The source file ends by observing something obvious and important. Market crashes happen again and again, and the ideal is to buy when prices are cheap rather than being the one who panics with everybody else. It also admits that timing is difficult and requires research and judgment. Fay turn 43 file 0 Fay. That is an honest ending. The only thing I would add is this: you do not have to predict every crash with movie level precision to benefit from that truth. You only have to avoid becoming fragile. That is what ordinary investors should focus on far more than they do. Fragility is what turns a market decline from an opportunity into a personal disaster. If you are over-leveraged, fully committed at absurd prices, and emotionally dependent on the market staying cheerful, then a decline owns you. If you have liquidity, patience, and enough emotional steadiness to watch others panic without joining them, then a decline begins to belong to you. That is the real division. Not between geniuses and fools, between the fragile and the prepared. Now, I want to say something about famous shorts like Michael Burry because people inevitably treat them as templates. They are not templates. They are case studies. And a case study is useful mainly for extracting the principle, not copying the surface behavior. What is the principle? Look under the story everyone else accepts. Study structure more deeply than the crowd does. Recognize when an asset class has become unhinged from reality. Understand the instrument you are using. Respect the path, not only the final outcome. Build enough staying power to survive being early. And remember that being right in theory is worthless if your structure cannot survive long enough to get paid. Those are very good lessons. But the lesson, go short the next bubble with leverage because one famous man once did, is idiotic. That is how people turn wisdom into self-harm. If you are an ordinary investor, the more applicable lessons are usually quieter. Read the market, incentives, know what you own, know what can hurt you. Know when enthusiasm has become excessive, know how fragile your own structure is, and know that holding cash when everybody else thinks cash is stupid can be one of the most intelligent forms of patience in the world. That is not market timing in the childish sense. That is strategic restraint. Now let me tell you one of the most underrated truths in all of investing. The ability to not be forced is a larger advantage than most people realize. A short seller gets ruined not only by being wrong, but by being forced. A long investor gets ruined not only by overpaying, but by being forced. A homeowner gets ruined not only by buying the wrong house, but by being forced. A business gets ruined not only by weak margins, but by being forced. Force is the enemy. Margin calls, liquidity calls, debt payments, psychological collapse. All of these are forms of force. That is why I always come back to the same idea. Your first obligation in markets is not to prove how clever you are. It is to remain standing. Once you remain standing, then the opportunities matter. Before that, they are just stories you were never stable enough to use. This is why even when I study sophisticated tools like shorts, swaps, options, or inverse vehicles, I always ask the same crude question. Does this increase my fragility or decrease it? That question saves people. Because fragility is what kills the ordinary investor, not ignorance alone. The file makes shorting sound accessible in one sense and dangerous in another, which is fair fay filicite fay turn. 43 file 0 fay. My stronger version would be this. Shorting is accessible mechanically. It is inaccessible emotionally and structurally for many people. And those latter barriers matter much more than the first. A person can open the account, he can learn the button, he can understand the example. What he often cannot do is survive the path. That is why I say learning the mechanics is valuable even if the trade itself is not for you. When you understand how shorting works, you understand more about leverage, asymmetry, market pressure, and the violence that can exist under surface calm. That understanding improves your long-side investing too. You become more humble, you become more suspicious of obvious narratives, you become more aware of what can happen when positioning gets crowded, you become more willing to hold a margin of safety. Those are all gifts. Now let me connect this to Buffett logic more directly. Why have I usually preferred buying wonderful businesses at fair prices over trying to make my fortune betting on collapse? Because ownership in a good asset has something a short usually lacks: time on your side. If the business compounds internally, if management allocates well, if the moat is real, then the passing of years can help justify your patience. With a short time often introduces costs, uncertainty, and new ways to be hurt. That is a very different relationship. And while collapse traders are busy trying to prove they are right about what is rotten, I would often rather own what becomes more valuable because life continues. That is not because crashes do not happen. They do. It is because there are easier ways for ordinary people to benefit from crashes than trying to become tactical short specialists. For most people, the better path is this. Own fewer foolish things near the top. Keep more liquidity than your friends think is necessary. Buy stronger assets when they are sold alongside the weak. And let the market's recurring panic do the hard work of giving you price. That is the real gift of downturns, not the thrill of betting against the world. The chance to buy parts of the world at better terms after the betting against it has already done its work. That is a lesson worth learning. Now let me finish with the cleanest version. The source file begins with the fantasy of the big short and ends by quietly pointing toward a much more universal lesson. Crashes recur. Market timing is difficult, and a great opportunity often comes from understanding overvaluation and then being prepared to buy after the break. Fay file site, Fay turn 43, file 0 Fay. That is where I would leave you too. Yes, learn what shorting means. Yes, understand borrowing, selling, covering margin accounts, stock lending, borrow fees, and why losses can be unlimited. Yes, understand inverse ETFs and why daily reset makes them more tactical than many people realize. Yes, study the famous short sellers and the intellectual courage it took to stand against consensus. All of that is useful, but do not confuse useful understanding with a personal command to imitate. For most people, the most profitable lesson in the whole subject is much simpler. Do not become the person forced to sell at the bottom. Become the person who still has the capital, the patience, and the courage to buy from him. That is how ordinary investors should think about downturns, not as a movie role, as a transfer. And if you position yourself correctly, the market will eventually offer you one of its oldest bargains, somebody else, as fear at a price you can afford. That is a much safer and much more repeatable way to profit from markets falling than trying to become a hero with borrowed shares and unlimited downside. That is the real lesson. And if you understand that lesson deeply enough, you may discover that the best way to short the market is often not to short it directly at all. It is to refuse to be trapped with the crowd. Let overvaluation collapse under its own weight, and then step in with cash when ownership gets cheap enough to matter.